First, I will start with disclaimers. Since this is a year-end webinar, by the way, it will be a little bit longer on the presentation side. I promised you that when the prior webinar was a little bit shorter. So disclaimers. This is not a solicitation to buy or sell any security ever. In fact, this is not advice. The results here are provided for general information purposes as a convenience to you, the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. Here is the agenda. We'll have an economic update, a market update, a reinforcement of my view of ChatGPT, a topics discussion of 2023, and a summary. And we're going to go so fast that we just finished the agenda slide. Here is the economic update. It will be a bit different than what I have done before. Far fewer nuts and bolts inside inflation indices and much more about the inflation indices because, as far as I'm concerned, inflation is over. I still believe, wholeheartedly have believed and will believe till the day I die, that an irritant was introduced in 2020. We called it COVID. And there were fiscal reactions to it. They too caused irritants. That irritant or those irritants wreaked havoc on our collective and personal psyches. It also wreaked havoc on our economy, jobs, inflation, GDP, both due to it in and of itself, but also the follow-on fiscal policy. So there was an earthquake in 2020. But the further we get from that irritant, the further we get from the earthquake, the less irritated we are. That's both in the market, the economy, and in our lives. The economy has recovered beautifully. Inflation is in free fall, unemployment is remarkably low, and the job market in general is robust, while real wages, that's wages after inflation, are rising, and they are the highest ever. At the same time, the discombobulated behavior has eased. Quit rates have chilled out. People aren't just quitting and getting jobs for twice the pay. Goods buying, chilled out. Stay-at-home behavior, chilled out. Supply chains, back to normal. We see this in all the data that I present to you in the dossiers and prior webinars. Right? But we're also finally starting to see it in sentiment. And no, things aren't as bad as they seem in a vacuum. But we don't live in a vacuum. Our health, both mental and physical, must heal from the pandemic itself. The further we get from the irritant, the less irritated we will be. It's this period, the after this period, where investors should be looking. That is where I am looking. That's where money is made and lost. You recognize the irritant, identify the impact of the irritant, and allow perspective to accept the end of that irritant. You need all three. If you have only two of those three or none of those three, you will not make it. Just these three things could make you angry. What I just said could be making you angry. Have patience with yourself. The irritant is fading. Now is time to receive that reality. The trauma is ending. Now care for yourself and others. It's this after this period. That's why we have a list of top picks. This is why I speak with CEOs and then share the conversations. It's because I'm looking at the after this period. Lastly, if conversations like this make you angry, that's okay too. Letting go of pain is hard. And in fairness, oftentimes trauma stays with us a lifetime. It's unfortunate, but it's true. But while not to make light of what happened during COVID, you are here to hear what I have to say about the market and the economy, and therefore I will move there. And I hope you do not feel that me moving to those subjects is somehow insensitive. That's my job. All right, inflation and the stuff impacting it. Short version. But first, I said last time that I had shifted from inflation is the only thing that matters to a slight change. What the Fed thinks about inflation is the only thing that matters. And I was right. And now the Fed thinks inflation is coming down too. And how do I know that? Because at the last Fed press conference, after the Federal Open Market Committee, we got two changes from Chairman Powell as the mouthpiece for the FOMC. Number one, he said, or did not say, that below trend growth would be needed to lower inflation. He had said that every single press conference after FOMC meetings up until the one we just had in December. He didn't say it. The second thing, the committee will cut rates even if inflation is not at 2%, so that the real rate of interest, which is the interest rate minus inflation, does not become too restrictive. I said what the Fed thinks about inflation is the only thing that matters. The Fed thinks it's coming down too, finally, and I'm going to show it to you with actual data, not just words. So here are some measures of inflation that we track. There's 6 inflation indices. Okay, and I'm going to tell you the difference between two of them, kind of the internal plumbing of inflation. First, this is CPI. Okay, on the top we have headline CPI, and the bottom we have core. Core is CPI, excluding food and energy. 4 webinars ago, CPI was at 6%. It peaked in the 9s, but I'm just talking about this year. We were at 6%. We did a webinar. It's down to 3.1. Core CPI 4 webinars ago was at 5.5%. It's down to 4%. This is PPI. It's the Producer's Price Index. It's like CPI, but for wholesalers. So CPI is for consumers, and PPI is for producers. In general, we like to think that where wholesaler inflation goes, so goes consumer inflation. PPI was at 4.6% year over year 4 quarters ago. It's under 1. Core PPI was at 4.4% 4 webinars ago. It's at 2%. That's the Fed's target. But the most important ones are the PCE and core PCE. I'm going to show you the numbers and then tell you why they're different than CPI. Okay? Kind of the internal plumbing. Core PCE is the Fed's preferred measure of inflation. It was at 4.6% 4 webinars ago, and 3 webinars ago, even though I was saying inflation was coming down, it had not changed. It was at 4.6 and it stayed at 4.6. It has now plummeted to 3.2 in 3 reports. That's like a 3 standard deviation move coming down that fast. Okay. And PCE, which is core PCE, but with food and energy, is down to 2.6%. Remember, this is the Fed's preferred measure. Before I go on, the question you might be asking is, why is this personal consumption expenditures inflation lower than this? Okay, here's some internal plumbing. Ready? CPI measures the price of a relatively fixed basket of goods. That doesn't have to make sense right now. I'm going to give you an example. PCE measures the price of things people are actually buying. Okay, I'm going to give you an example. Let's pretend prices remain completely steady for a full year. All prices, everything, from a battery to cars. But all of a sudden, the price of bread went to $1 million a loaf. Just bread. It was just bread. Just bread went to $1 million a loaf. Okay, CPI would skyrocket because bread is in that basket of things they measure. But in reality, nobody would buy bread. They would just buy rice or tortillas, right? So PCE, in that case, since people would not be buying bread, would be unchanged. Right? So that's the difference. CPI looks at prices of a basket of goods that are fixed. PCE actually comes from the GDP reports, what people are buying. So it's more important that PCE is at 2.6% than CPI is at 3.1%. But they're both important measures of inflation. But there's a reason the Fed has a preferred measure. The Fed cares about what people are actually spending on. The price of things you and I are spending money on. PCE is at 2.6%. Inflation is dead. Some other ways to look at these inflation measures. The Cleveland Fed has something they call the nowcast. It's updated every day. It's algorithmic. There's no human beings. It's a forecasting model for inflation. Okay. And in the nowcast, we see 2 things. First, throughout this quarter, the model kept lowering forecasts as it was receiving more and more information. And here's how it looks. Okay. This is as of December 7th. Just see where, so this is PCE, core PCE, CPI, and core CPI. So the 4 of those 6 charts I showed you, this is the inflation. You can pick any color and see where it started and ended, right? It's all going down. So as of December 7th, as new information was coming in, the nowcast was going down. But look what happened as of December 25th. We had this monstrous drop. I'm gonna make these images bigger. So this was the trend through December 7th. Then on Christmas, it totally and utterly collapsed. I'll make it even bigger. Inflation is coming down faster than the Fed anticipated. It's faster than even algorithmic models can anticipate. Something is changing. Remember, these are not human beings. This is algorithmic. I'm going to show you what the Fed thinks in a second. And to show you how it's happening in another way, core PCE, the Fed's preferred measure of inflation, this blue line year over year, is at 3.2%, right? And the target is 2. But if we look at the 6-month rate annualized, it's already below 2%. And we look at the 6-month rate as a measure of where it's headed. Right? Okay. Now I'm going to show you what the Fed thinks. In September, in the press conference, the Fed said they thought GDP in Q4 will grow 2.1%. Just 3 months later, it's now 2.6%. That's actually from an Atlanta Fed nowcast. The Fed said in September that the year would end at 3.3% PCE. It's already at 2.6%, and we don't have the December numbers yet. Those come out in late January. The Fed said in September, we think core PCE is going to be 3.7%. Just 3 months later, we're at 3.2, right? The Fed thought this number would be 3.7. That's what this means. Inflation is collapsing. This is irrespective of oil. And then we have some Fed funds rate information. The Fed thought they were going to be raising again. They realized they will not be. The Fed thought, as of September, the Fed thought at the end of 2024, rates would be at 5.1%. Now the Fed itself thinks it'll be 4.6. The Fed itself is pricing in 2 or 3 cuts. I'm not talking about the futures market. I'm talking about the Federal Open Market Committee. So I'm going to just take a snippet of a slide from earlier. I said what the Fed thinks about inflation is the only thing that matters. I was right, and now the Fed thinks inflation is coming down too. Here, see? The Fed thinks inflation is coming down too. It's not what Ophir thinks. This is what the Fed thinks. Okay. And it wasn't just inflation. It was GDP. I'm going to show you a chart from Joseph Politano. This is going to be a chart of what the Fed thought GDP would grow in 2023, going back in history. So this is all for 2023. This is what the Fed thought. Oh my gosh, GDP is going to collapse. And here it is. And I want you to notice something. If the Fed would have just shut their mouths, they were dead on the money. They were right in 2021. They were right in halfway through. They were right in 2020. They were right in September of 2021. This is exactly where GDP is. All of this is what gave us all heartburn. This too. This too. You can go all the way back to the end of your webinar for 2022. And I said the Fed's expectations, the median expectation for core PCE inflation is too high. It doesn't make sense. And I was right. How is inflation coming down? Whoa. All of these things, I call it disinflation station. Japan is in disinflation. It's not just the US. Eurozone is in disinflation. The UK is in disinflation. Rent is in disinflation. Food is in disinflation. Services are in disinflation. The labor force participation is back. Prime age labor force participation is almost at all-time highs. Job openings are falling. Payrolls are falling. Wages are in disinflation. I think I said that twice. Consumer savings are down. I'll show a chart of that. Bank risk is still elevated. Credit card spending is down. I'll show a chart of that. And all of the inflation measures I showed you, those six measures, they're all coming down. So this is what I think. I think history is going to record that those who believed in the transitory nature of inflation, while we underestimated the duration of that transitoriness, were essentially correct. Remember when I spoke about identity economics? I said this way back in 2021. And I said, there are some very influential people who have staked their reputations on the idea of hyperinflation. They also staked their wealth on it. And further, that they would fight tooth and nail to the death, I said, I was being colloquial, to defend that idea. And I told you, I got, I don't know, maybe 300 emails. People said, who? And I said, I don't want to say who it is because they're going to harm our business. Well, that person no longer can harm our business. That person was Jack Dorsey. He said in October of 2021, hyperinflation is going to change everything. It's happening. He said, and 25,000 people retweeted that. He said it will happen in the US soon, and so the world. And then later on, he said those people who believe we won't have hyperinflation are the same people who believe in Santa Claus. Remember who you're listening to if you're listening. Jack Dorsey is a magnificent entrepreneur. He knows nothing about economics. He put a monstrous bet on Bitcoin. I mean, a monstrous bet on Bitcoin. And he needed this to happen. This was his identity. He would defend this to the death. And now nobody gives a shit what Jack Dorsey says about inflation. So I think people will, it will show that it was transitory in nature, although far longer. That transition was far longer. The irritant, the situation, was intrinsically temporary. Right? It extended over several years, and it all unfolded due to the pandemic. Ultimately, this will lead to, hopefully, not guaranteed, a gentle resolution, primarily because of the pandemic's impact. But we cannot have a Fed that is overly reactive to the past. We cannot, and they have been. Right? I showed you that picture of their forecasts when they really should have just stuck with their forecasts. The Fed's tools operate with a lag. The Fed must be more strategic, less reactive. And as I said 9 months ago, if the Fed continues to signal hopelessness, the market will oblige. That's what we saw with the SVB and FRC bank collapses. The Fed is being a little less hopeless now. Remember, I called out Neil Kashkari. I said that guy, the words coming out of his mouth could cause a disaster. And that he was not only wrong, he was dead wrong. 2, 3, 4 standard deviations wrong. I was right. He was wrong. The Fed's impetuous language could undermine the standing of the entire global financial market. They could bring the whole fucking thing down. Remember this? This is impetuousness. The Fed can still break something. So while I sound optimistic, that does not mean I am not cautious. I think there's still a reason to be cautious because of what I just said. The huge Q3 GDP numbers were driven by households and a lot of government spending, and the government spending part doesn't really recur. Households, their credit card delinquencies are rising. I told you I'd show you a chart. Here it is. This is the kind of chart Jack Dorsey would show you. Like, look, we're going into a massive recession now. Look at the hyperinflation or hyperdisinflation or something. But that's not really the chart, right? This is the chart. This is the same chart. This is right here. So yes, credit card delinquencies are rising. I'm not saying they're not. I'm telling you, I'm partially cautious because of this. I'm not sticking my head in the sand. I'm just saying when you look at this chart on Twitter, what you're really doing is making yourself dumber. So don't make yourself dumber and get off Twitter. I said the savings rate is dropping. It is, but I mean, it's kind of long-term trend. Savings rate, it's dropping, right? Sure, that's all the money from fiscal policy, blah, blah, blah. It's true. I thought it was a bigger deal than it was. And then after the after the third quarter webinar, I read some papers and I was like, yeah, I think I overstated it too. People are making money. Real wages are higher. As you can see, savings rates are going up. People aren't just spending money because they got flush with cash. They're actually spending money because they're making more money than they ever have. More people are making more money than ever before in the United States. That's just the truth. How it's not causing inflation, I have no idea. So I think while I'm cautious, right? So I'm saying I'm cautious and I'm giving you reasons why the GDP numbers might be a little bloated. I'm also telling you any reasonable and unbiased person would say this, while noting those risks, that 2023 has been inconceivably good for the economy. It's just completely inconceivable. In fact, I know a reasonable person who said that it's inconceivably good. And then I tried to explain it. And that was on December 22nd. You can both be cautious and recognize that it's been inconceivably good so far. So far. Right? Now, in 2023, I thought we were going to have a recession if the Fed followed through. And the Fed did follow through, in fairness. They did. In 2024, there's more evidence to support that next year will be good than it will be bad. But I still think there's reason to be cautious. And one last thing. If you're sitting there and you're thinking to yourself, inflation is going down, not where I live, bruh. Not where I live, bruh. Let me show you why you feel that way, because you're right. But so am I. And this is where there's a disconnect between what people experience and what economists look at. Okay, this is it. These are the prices of new cars and used cars. This chart doesn't show you much, so I'm going to mark it up. Okay. If you look back in 2020 and look at the circles, just look where prices went. That's a huge amount of inflation. A huge amount of inflation. Look what these were headed at. Look at this. Look at the used cars. Should be what, around here? Huge inflation. But that's not what economists are talking about. It doesn't mean you don't have to pay more for cars. That's true. But this is what economists are looking at. Right? It's this. In the last year, it's flat to down. So I'm just going to keep the arrows. This is what we feel as human beings since 2020. This is what economists are talking about. Just so you know, where is the disconnect? How can inflation be coming down when you look around and you're like, dude, the prices are huge. They're both right. The arrows are big, but recently the arrows are small. And economists look at the last year. Fair or unfair, I'm just trying to connect your feelings with what you're seeing in the headlines so you don't feel crazy. I don't want you to feel gaslit, basically. Okay. All right, that's the economic update. I told you I wouldn't go too far on that. Now the market update.